Natural gas slipped lower on Tuesday, cooling off after Monday's forceful breakout that propelled prices through the well-watched $4.75 barrier and briefly pushed the front-month contract to $4.98, a level not seen in nearly 3 years. Even with the pullback, the short-term weather backdrop remains broadly supportive. A series of frosty systems is sweeping across the northern and central U.S. into early December, delivering daytime highs in the 10s to 30s and sending overnight lows plunging below zero in certain pockets. That's the kind of pattern that reliably fuels strong heating demand. Beyond this immediate cold shot, however, visibility becomes far less clear. Over the weekend, model runs diverged sharply, some leaning colder, others softening, leaving the 7 to 15-day outlook firmly in wait-and-see territory. Traders should expect pronounced volatility in both forecast updates and price behavior as the market tries to decipher which trend takes control. Weather can turn on a dime, and participants are well aware of how quickly a bullish setup can unwind. At the same time, the supply side continues to cast a heavy shadow. U.S. dry gas production climbed to 111.8 billion cubic feet per day on Monday, marking a nearly 7% year-over-year increase and reinforcing just how unrelenting output has become. The rig count supports the trend as well. Baker Hughes tallied 130 active gas rigs last week, the highest level in more than 2 years. Interestingly, when the rig count last hovered around the same level back in June 2023, natural gas prices were trading in a completely different landscape. Despite similar operational activity, futures were fluctuating near $2.60, underscoring how much broader market conditions, from weather to storage levels to overall sentiment, can reshape the price environment even when supply-side indicators look comparable. Adding to the weight, the EIA recently nudged its 2025 production estimate up to 107.67 billion cubic feet per day, a reminder that any weather-driven rally still faces a wall of supply ready to cap upside momentum. Storage sits comfortably 4.2% above the 5-year average, not tight enough to ignite panic buying, but not loose enough to spark a collapse either. In other words, inventories are adequate, and the market knows it. From a technical standpoint, holding the line above $4.60 keeps the advantage firmly with the bulls. As long as that level continues to act as a springboard, buyers have room to probe higher. A decisive push to fresh session highs would reopen the path toward $5.10, though reaching that zone will almost certainly require a meaningful catalyst, whether it's a colder shift in the late-run models or a storage draw that materially outperforms expectations. If the market slips back below $4.60, the tone changes quickly. Losing that support would signal that bullish momentum is fading and would likely draw sellers back into the mix. Should downside pressure build, the next key waypoint becomes the 200-day moving average at $4.73, a major trend gauge that has repeatedly served as a stabilizing floor. A test of that level would determine whether this market is simply retracing or preparing for a deeper correction. If you enjoyed the video, drop a comment, hit like, and consider supporting the channel. It really helps keep things moving.